Hello and welcome to this very special CNBC-TV18 Market Town Hall. A market holiday, I reckon, is the perfect opportunity to reflect and take stock of where we are and where we go from here. A little bit of crystal ball gazing is what we have in store for you. Now, to be sure, the gazing is going to be done by one of the foremost global equity strategists, Christopher Wood of Jefferies. Chris started writing his famed Greed and Fear note back in 1996. I personally have been reading it since 2004. It really still is the best take you will get about diverse investment opportunities, topics, and different markets week after week.
Oh, yes, absolutely. That was around the time I started looking at the markets here in India as well. Wow, it's a long, long time ago. Now, market lore about greed and fear. The note is that Chris writes this note usually in the country in which, he's traveling. So he's probably going to be in a different country every week or maybe a different city every week. But that's the folklore really surrounding greed and fear. Chris has been a big believer of India for some time now. Christopher, thank you so much. Let me welcome Christopher Wood, global strategist at Jefferies, to come up here on the stage and please join us.
Thank you.
Chris, thank you very much for being here.
Thank you.
Great to have you with us, as always. So I read out a bunch of statistics and I could have gone on, which showcases the performance of India. It's been extraordinary. I mean, when we report on markets day on day, we sometimes have to pinch ourselves and really ask ourselves, is this really real? I mean, or are we in a dreamlike state? You've been bullish on India for a long time, for a few years now. Are you still as bullish? Is India still your favorite market?
No, yeah, India's still, basically I've taken the view really, I suppose since the start of the century, that India is the best long-term equity market in the world. Clearly the US has done fantastically well. But in the emerging market Asian context, India to me remains the great domestic demand story. You have this very emerging equity culture. But what, as you rightly have just highlighted, is amazing is the dynamism of the local asset management industry and the growing retail participation. And actually everybody, I've been in Mumbai 2 days, everybody from the financial industry, I think, is staggered by the resilience of the market following the surprise election result. Myself included.
That was a surprise, that was a shocker.
Yeah.
And I don't think anyone here in the audience as well thought the market will do what it did. One day there was a fall.
One-day fall, that's it.
And bounced right back to new highs.
No, I am staggered that the market only corrected one day. But what's interesting is that the domestic fund managers, the stockbrokers, I think have exactly the same view, and I suspect that a lot of them sold stocks that day, and retail bought it off them. So it's a very unusual set of circumstances.
Chris, before I ask you market questions, what about the Mumbai monsoon? How have you managed to brave that? I think you got in over the weekend?
No, I have not been in India in the monsoon since I was an undergraduate. When I was an undergraduate, I lost my passport in Bombay in the monsoon.
Oh, now that's a story. That's a story, right? Okay, more of that in a bit. But, to get back to this fantastic market we've had here, and it's good to get a perspective from someone who's watching so many global markets, right? Because we sitting here sometimes feel that, is it getting excessive? We've not had a meaningful correction. Corrections are so shallow. They last 300, 400 points on the Nifty, and that's it. There's this gushing domestic liquidity that Prashant mentioned. What do you make of all of it?
Well, I think fundamentally it's extremely good news that you have growing domestic participation in the equity market. So I think the positive story is to see this as the beginning of an emerging sort of an equity culture. And if you go back to take the US example, between 1980 and 2000, we had a huge growth in equity investing in the US with the arrival of the 401k portable pension plan. So my understanding in India is you've got these emerging saving schemes which encourage equity investments. So I think that's just a long-term positive story. But in recent months, you've had growing direct retail participation as well.
Yeah.
So to me, when I was asked what the biggest risk in the Indian stock market was before the election, actually, the biggest risk to me wasn't the election result, because I had the wrong view on the election result. I was looking at the potential for capital gains tax increases. Either an increase in the levy or the extension of the period where you have to hold a stock before you are considered a long-term investor.
You said that was a view you had before the election result.
Yes.
Now you don't worry there'll be a tax increase?
Well, I've got no idea, but I'm getting the sense from talking to local market participants, they think that risk is less likely.
I mean,
more likely to have action on this whole option.
On the options.
On the options,
Yeah.
futures and
Yes.
options.
And we'll get to all of that in just a bit. But, just to go back to the market reaction and how retail came in, I mean, is that also a buffer to anything adverse which may or may not come out of the budget? I mean, we have the recent experience, 4th of June, when, I mean, it was a negative outcome from a market perspective. The market bounces back. So same thing could happen on the 23rd.
Well, I think there's a real rise in capital gains tax that would hit the market more than what happened after the election. But it seems like it's not good. It seems like the possibility of that has been reduced.
I mean, it's a thing which comes up before every budget, right? Rationalization of capital gains taxes. And so far, and I think at a philosophical level, governments all over the world also want markets to do very well, right? I mean, I think it's, and that's worked. There's a huge wealth effect. Why would you want to spoil it?
No, I know personally, many markets, there's no capital gains tax. In Hong Kong, there's no capital gains tax. And so there's actually, personally, I think you should have no capital gains tax, from my own personal opinion. But if you are going to have a capital gains tax, it makes sense to encourage long-term investment and have a big difference between long-term and short-term holdings.
You said that it will be more meaningful as compared to the election result if something were to come through. I mean, just elaborate on that a little bit more.
Well, no, because that just increases the risk-reward ratio of investing in stocks.
Chris, before we start talking about what you've liked in India, and you've been a big bull on property here, and I think maybe even ahead of the curve, ahead of many others, because you've got that spot on. But before we talk about what you've liked, or what you like, or what you're changing, again, just to understand the kind of domestic liquidity that's hitting the market, it's unprecedented. We've not seen it before. So what are the examples we can draw from global markets when this kind of money started coming through? Because the fear here is that going to create a bit of an asset bubble? And will we sort of have to deal with absolutely elevated, price to earnings multiples? So
the best example is that US example of the 401k driving growing equity ownership. And my understanding, obviously, the excess valuations in India, or the perceived excess valuations of the small mid-cap area, but my understanding in recent quarters, they've had the best earnings growth too. So it's not completely divorced from underlying fundamentals.
So you don't sound too worried?
No, to me, the where you see the risk of excess is in the direct retail participation, as opposed, because a lot of the money has been direct retail participation as opposed to the installment flows.
Mutual fund, the SIPs.
For our viewers, just to complete that point, and you sort of compared the situation here, the local money coming into the US example. What happened then in the US?
It was a long-term bull market.
How many years? And I mean,
that whole equity couch has been driving, started off in 1980 and basically ran until 2000. Then we had the NASDAQ. But essentially, it's been a benign cycle in the US and the households own equities. And that's one reason for the resilience of the US economy during this current monetary tightening cycle.
And once that money started coming in the US, was there a big difference how markets behaved post the 80s and before the 80s in the US?
In the 70s, the US stock market went nowhere because of inflation. It was just flat.
No, I'm saying, was there a structural sort of lift and buffer to the US stock market?
Yeah. So fundamentally, it's extremely healthy if the Indian stock market is driven by domestic flows and not dependent on what the foreigners are doing.
Okay, so that's out of the way. I think you've made it very clear that you don't see that as a risk. In India, locally, looking at things that we've discussed, capital gains, which could be a risk. Apart from that, anything else that kind of worries you or kind of tickles you at all?
No, the only issue, the risk in India is simply that some of these stocks are very high valuations, so there's a risk of earnings growth disappointments.
So earnings will have to grow into prices in that sense.
So, like, to give an example, the real estate stocks I've had in my portfolio for Greed and Perth portfolio a long time, but last year I would have added energy and more capex plays. So the capex plays have done very well. So obviously, if the order flows don't come in, that would be a risk.
Where are the foreigners? I mean,
well, on the foreign, so this is extremely interesting. The very bullish, the big point for your viewers to understand is the foreigners are remarkably underinvested in India. So we believe that the global emerging market funds, who are the prime investors in Indian equities, are barely neutral in India, partly because the neutral weighting of India has gone up because it's outperformed, and partly because they haven't really been able to get into the market because the local money has kept it at valuations where they're not comfortable with. But there's another point. Most foreign portfolios are still strongly influenced by what I would call legacy positions because they have big holdings historically in IT services and banks, which are a big part of the traditionally of the MSCI India index. And while these are perfectly okay stories, they've not been where the performance has really been coming from. So what we're seeing is foreigners gradually capitulating and reducing the holdings in banks and IT services and adding to these hotter areas. But, they're basically behind the curve.
What we'll do is we'll take a quick commercial break. Ramesh and Utpal and others are all here. And we will continue this very interesting sort of back and forth discussion, interaction on the other side with all the D Street stalwarts and Christopher Wood of Jefferies. Stay with us.